When it comes to S corporation stock, only certain types of trusts are eligible to own this type of stock. Now, with grantor trust reform potentially on the horizon, a particular form of trust, called the electing small business trust, may become more popular. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 245, is all about the basics of the electing small business trust, or ESBT. We'll dive into some of the high-level qualification issues that come into play when you're looking at the ESBT and comparing it to other forms of S corporation trusts that qualify as shareholders. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, what is an S corporation in general? In case you don't know, corporations, when organized at the state level, are by default C corporations under the Internal Revenue Code. What that means is that the corporation has a corporate level income tax on its earnings. Then when the earnings are distributed out to shareholders, this is a dividend, which is also subject to tax to the shareholders themselves. But a corporation can make an S corporation election if certain requirements are met, which removes that corporate level income tax and forces all the shareholders to instead be personally liable for tax on their share proportionately of the S corporation's income. Now, a big requirement is that typically you can only have individuals as shareholders who are U.S. citizens or residents in order to make an S corporation election, and you have to have 100 or fewer shareholders to qualify. Now, there's some types of exceptions out there, things like charities, which is a newer creation that you can have a charity as a shareholder, but typically you're limited to individuals, and a red flag needs to go up anytime you are looking at an S corp that doesn't have an individual who's a shareholder. And that extends to trusts. Trusts generally are restricted from being shareholders unless they're structured in a certain form, either internally or by election, that allows you to look through the trust to identify individual beneficiaries who are deemed shareholders. So what this generally means is you have to have a grantor type trust, either with respect to the grantor, which is pretty common, or with respect to one beneficiary who's entitled to receive all income and is the only principal beneficiary. So the latter that I just described with respect to a beneficiary is the typical structure for a qualified subchapter S trust, or QSST, which is the most popular form of trust ownership of S corporation stock. Now, I'll talk about why in a minute, but the threshold question is, with grantor trust reform potentially on the horizon, is there an option to have a non-grantor S corporation trust? And the answer is yes, there is, in the form of the electing small business trust, or ESBT. It's a non-grantor trust, but there's costs to making this election and qualifying for it. One is that once you make this election, all of the ordinary income of the trust will be taxed at the highest income tax rate that's applicable to trusts for that given year. Currently, that's 37%, but it could increase to 39.6%, plus having some additional taxes added on, such as an extension of the 3.8% Medicaid net investment income tax trust, which could be extended to passive business income, and also a 3% high earner income tax, which could apply to trusts to the extent their income exceeds $100,000 for any given year. So this is a number that's climbing, and it may not be the optimal time to have an ESBT if you're just looking at tax rates. Now, you can have capital gain apply in an ESBT as well, but it either has to be passed through as a distributive share of corporate income from the S corporation, or it has to be attributable to the sale or exchange of S corporation stock by the trust itself. And you may be thinking, hey, is there any way around this? Can we maybe distribute income out to beneficiaries and get a D&I deduction to reduce this tax load? And the answer is no. No matter whether the income is accumulated or distributed, there is no D&I deduction, and the trust pays all the income tax on that income at the highest rate. And you have to count each potential current beneficiary as an individual S corporation shareholder. So you count this by looking to any beneficiary who who could receive a distribution of income or principal from the trust at any given moment, and they will be treated as an S corporation shareholder, which you can see might cause some problems when you look at who actually qualifies on an individual level as an S corporation shareholder, as we talked about a minute ago, when you're qualifying an S corporation itself for that election. Now there's two layers of beneficiaries here. To make the election for the ESBT trust itself, you can only have qualified beneficiaries. Generally, they must be individuals or non-governmental charities. Now, you could have a governmental charity, but only as a contingent remainder beneficiary. Now, note that we're only looking to the beneficiaries themselves here and whether you can qualify the trust for the ESBT election. You also need to note that if you have a power of appointment over the trust, any permissible appointees under that power of appointment don't count towards qualification for the ESBT election unless or until that power of appointment is exercised. So, in order to avoid an inadvertent termination of either the ESBT qualification or the S corporation qualification through the exercise of that power of appointment, care must be taken if, for example, you're the individual drafting the will to exercise that power of appointment. Now, we've looked at the qualified beneficiaries just for the ESBT election itself. You also have to balance that with an underlying qualification, because remember, you look through the trust at potential current beneficiaries to determine whether they actually qualify as S corporation shareholders. So, even though a beneficiary might qualify under the ESBT election standard, they may not qualify under the S corporation election standard under that look-through rule. So for example, if you have a charitable remainder trust which becomes a potential current beneficiary, this will blow your S corporation election. That's a bad outcome. We'll talk about that in a few minutes as well. But there's one weird exception here that really kind of may be one of the plus points to an ESBT overall, and that is that typically a non-resident alien cannot be an individual shareholder of an S corporation. But if that non-resident alien individual becomes a potential current beneficiary under an ESBT, then under those look-through rules, they can count as an S corporation shareholder for purposes of the 100 shareholder requirement, even though they wouldn't on an individual level qualify as a direct shareholder. So if you have a non-resident alien in the mix and they can't receive S corp stock directly, this is a good way to get around that requirement by making them a beneficiary of a trust that makes the ESBT election. So to make this election, there's a timing aspect. It has to be made within 2 months and 15 days of the date on which the trust first acquires S corporation stock. And that election relates back to that date of acquisition of S corporation stock. Now, how do you make this election? Well, the problem is that no matter what, you have to have a typewritten election statement containing certain information that's filed with the IRS. Now, unlike the QSST election, which can be made on Form 2553 if that election is made concurrent with the underlying S corporation election, you don't have that option with the ESBT election. You're limited in all cases to an election statement. Now, I also want to mention that you may have a trust that's a grantor trust, maybe with respect to the grantor, and if that grantor trust status terminates, then you have 2 months and 15 days in which to make the ESBT election after that termination of the grantor trust status, if indeed you want to make that. Otherwise, after that date, that trust could cease to qualify as an S corporation shareholder. So a big question that often comes up is whether or not you can convert between an ESBT and a qualified subchapter S trust or a QSST and vice versa. Now generally, if you're looking at an ESBT, since that's what this discussion is about, the letter of the law and the regulations says that a QST does not qualify as an ESBT. But there is a carve-out procedure that allows you to convert over to an ESBT with IRS consent based on a procedure which really kind of warrants its own separate discussion. We're not going to dive into that in great detail here. But there is a time limitation overall that you need to know above and beyond anything else, and that's that you can only do this once every 36 months. So if you have a QSST that you convert to an ESBT, you have to do it at least 36 months after the QSST election was made potentially, and you have to wait another 36 months to convert, and vice versa. So you have that time limitation in place that you need to be conscious of. Now, the big problem, as I mentioned, is that you're looking not only at qualification of the trust for the ESBT election, but also looking through at the individual trust beneficiaries. And as we've seen, any potential current beneficiary other than a non-resident alien who wouldn't qualify on an individual level for or as an S corporation shareholder could also terminate the S corporation's election if and when they become a potential current beneficiary. Now, if this happens, there may be some relief available if you can show that the termination was inadvertent, maybe due to the internal workings of the trust itself. That also requires its own separate ruling request procedure with the IRS. But there is one exception here to note, and that's that if you have an ineligible S corporation shareholder who becomes a potential current beneficiary, then you have 1 year to dispose of all of the S corporation stock, and if you do so, if the ESBT disposes of all that stock in the 1 year period such that that ineligible potential current beneficiary is no longer a look-through S corporation shareholder, then you can avoid an inadvertent termination. So this at least gives you a runway to be conscious of that within the S corporation and the ESBT itself. So there's lots of depth to several of these subtopics we've looked at. Many of them, as I've mentioned, could warrant their own separate discussion. But I hope this gave you a good overview of the ESBT Trust and what goes into it. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But thank you again for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.